You want to get rich? You want to double, triple, quadruple your money overnight without taking any risk? Come on, you're much smarter than that now. If you've seen the first 3 lessons, you know that's not possible. So let's get real and see the first of 2 ways how you can get the most of your money in this week's lesson. What's up everyone? Welcome to a new video from PerFinEx, the #1 financial planner for expats living in Germany. By the end of this lesson, you will know the second of 3 sides that make up the magic triangle of investing. Last week we talked about the first side. If you missed it, you can watch the lesson right here. But before we begin, let's answer last week's quiz question. And the right answer is B. 1 lousy euro per year. That's how much you're getting on average on a German bank account for 10,000 euro invested. Don't spend it all at once. Speaking of don't spend all at once, this video is only for people like Amanda who have their emergency fund filled up. If you don't, like Steve, you're missing step 1 of investing. But if you do, you're probably looking for some return. That's why we're talking this week and next week about the only 2 strategic ways to get more bang for your buck. Letting loose of safety or letting loose of availability. Let's go! Coming from the strategic level, saying that availability is important, return is also important, and safety is not that important. We have on a product level traditionally stocks and bonds, mutual funds, index funds, ETFs, exchange traded funds, and even commodities like gold or oil or cryptocurrencies like Bitcoin or Ethereum. Between all of those, we see one fundamental difference, and it's in the way they can return a profit. If you watched the last 3 lessons, you know that our boy Steve doesn't have the smartest approach to investing. That's why he likes to buy cryptocurrencies and gold. I'm not saying it's bad. I'm saying that these asset classes only offer one way of making a return, if the price rises. Let's say you're buying an ounce of gold or a Bitcoin today and hold it for 20 years. In 20 years, you will have exactly 1 ounce of gold or 1 Bitcoin. It won't have done anything for you in between. So all you're doing is speculating that you can sell it for a higher price than you bought it for. And that's gambling as far as I'm concerned. Amanda, on the other hand, is smart and doesn't like to gamble her life savings away. So she buys reproducing assets. If you buy a bond or a stock or an investment property, what we will talk about shortly in more detail, these assets will produce something for you that you can use to buy even more assets. Bonds pay interest, stocks can pay dividends, and investment properties pay rental income. These asset classes will reproduce itself and make some money. And after 20 years, you will still have your full bond, stock, or investment property. A decent productive asset of any kind is gonna outperform a non-productive asset over a long period of time. And Amanda knows it. So say it with me. Be like Amanda, not like Steve. But wait, what is a bond anyway? A bond is simply a loan. Companies and governments issue bonds frequently to fund new projects, ongoing expenses, or whatever. Anybody can buy these loans and generate a nice return for himself, because whoever is lending money from you has to pay you interest. You could get interest payments from the Federal Republic of Germany. Isn't that cool? Bonds are often viewed as a less risky alternative to stocks because lending a company money is much safer than becoming an owner of a company. But wait, what is a stock? A company can decide that it wants to sell tiny pieces of itself on the stock market to people like Amanda and Steve, you and me. like this for Apple. Of course, your piece of the apple is very small if you just buy one stock, but you are directly involved in the success and the failure of that one company with your share. And the more people believe in the future of this company and buy a piece of it, the more the price rises, and vice versa. If more people want to sell their piece than people want to buy a piece, the price falls. The simple law of supply and demand. And when the company makes money, it can pay a share of its profit to anyone who owns a piece of it. That's what we call dividends. Kind of similar to a bank account or a bond that would pay interest on your investment. Stocks can be bought and sold at almost any time. That's why they are very available. But attention, at their current value. Stocks, obviously, have their ups and downs depending on how successful a company is. You can see it in the news. That's why we're saying that safety is kind of left off the table here. I'm not talking about a stock market roller coaster that goes up and down, but stocks fluctuate. As anywhere, there have been great success stories like Warren Buffett, who made billions investing in stocks, right next to tragic failures of people who lost billions during the dot-com crash or the global financial crisis in 2008. So if return can be high and availability is high, let's try to get the most safety possible, because please don't kill the messenger, but the chance of us or you finding the next hot stock or the next cryptocurrency right before its value is exploding is in fact very, very, very low. So betting everything on one horse is just outright stupid. And who is really stupid? Stevie boy. He's willing to take the chance and bet his hard-earned life savings away by investing into the next hot stock or cryptocurrency. His friends told him to buy a company that produces sunglasses because they are having a good feeling about the company. When does this stock make most of their profits? In summer, of course. So hopefully Steve is halfway smart, and instead of owning just one stock of one company, he spreads his risk and buys a stock of a second company. A good addition would be a company that produces winter jackets, because this company makes money in winter. You can already see certain opposite effects and the curves shifting. But in spring and autumn, Steve is still at zero. So hopefully Steve is like 3/4 smart and buys a third stock of a third company. You're thinking of something that makes profit in spring and autumn now, don't you? Ha! Got you. Steve better buys a company that has no seasonality. Toothpaste, for example. I'm assuming people brush their teeth all year round. Now, in reality, there are lots of companies producing sunglasses, winter jackets, and toothpaste. And you and Steve want the best, of course. So you somehow need to filter them, which is pretty difficult, to be honest. A good idea is, instead of buying individual stocks, you can buy a whole basket of stocks, which is called fund. A fund follows a certain strategy that is either defined by a professional fund manager who supposedly knows what he's doing, then we would call it mutual fund, or a computer, then we call it index fund or ETF, exchange traded fund. The difference is easy. The mutual fund manager is a real human being that is actively deciding which investments to buy and which investments to sell, whatever the current market situation and his strategy is. His goal being to make the most profit possible, of course. An ETF, on the other hand, is passively managed, meaning that computer programs just buy an index straight up as it is. For example, the Standard & Poor's 500 index, in short, S&P 500. This is an index of the 500 largest companies in the US. And we don't need a human to replicate this index. A computer can do it much better and much cheaper. There are a combined more than 70,000 funds available on the German market, investing into stocks, bonds, real estate, different regions, different industries, different currencies. There are mixtures, whatever. There's even more funds than stocks. You can invest in anything you want. Now, again, as you already know me by now, there's no right or wrong here. Every single fund has a right to exist, just like us humans. The big benefit of all funds is that they are pretty convenient. Most funds pool hundreds or even thousands of individual investments together that you all own by simply buying this one fund. Without funds, you would need to buy all these individual investments yourself one by one. So hundreds of times pressing the buy button, hundreds of times trading commissions, and of course a lot of money required to buy hundreds of individual stocks. So funds save you time, money, and effort by giving you instant ownership in one easy package. So hopefully Steve can learn something from Amanda, because she's pretty smart and understands that every single fund, doesn't matter if it's managed by a human or by a computer, has its very own strategy. A strategy that unfortunately might differ from yours as the investor who bought the fund. Let me explain. Each fund has a comparison to measure its performance with, a so-called benchmark. As the computer-managed fund simply replicates an index, it wants to be exactly like its benchmark. A human fund manager, on the other hand, wants to be better than its benchmark. That's why you're paying more fees for the human fund manager, because these funds want to perform better than average. Let's take a look at what that mutual fund strategy means for your personal investment strategy. Let's say a benchmark makes plus 7% in 1 year and the underlying fund makes plus 8%. Then everyone's happy, the fund manager's happy because he outperformed his benchmark, and you are happy because you got an 8% return. Isn't that awesome? In the following year, the same benchmark returns minus 5% and the underlying fund minus 4%. The fund manager, who supposedly knows what he's doing, is still happy because he is still better than average. But you're not happy, right? Because you lost 4%. Very similar to the ETF, by the way, who would made 7% in the first year and lost 5% in the second year, just like the benchmark. Amanda understands that investing is not about a chosen fund strategy and random averages. She focuses on her own strategy, and you should focus on your strategy too. Investing is about a steady growing performance with limited risk. So the least possible roller coaster, regardless of any index or benchmark or whatever. Especially if you do not have an unlimited amount of time to invest. If you invest with a short time frame, let's say you want to buy a home for your family in 5 to 10 years, you are taking an incredible amount of risk by investing into funds with a long time frame. You are basically gambling with your dream of buying your family a home. There's only one thing we need to understand and never ever forget. Return comes from taking risk. Last but not least, today's quiz question. What's better? An ETF, exchange traded fund, that is managed by a computer, or a mutual fund that is managed by a real human person? Is it A, the ETF? Is it B, the mutual fund's better? Or C, it depends? Let me know your guess in the comments and I'll answer the question in the next lesson. Next week, we're talking about the safer approach to get return. Beautiful Germany offers certain products and allows us to invest in risky funds and put a safe umbrella over it. But more about that next week. Do you already know what's safe and brings return? Let me know, drop a comment below. If you don't know yet and want us to find out together what the right way of investing is for you, scan the QR code and book your free meeting with us. And if you got any questions, write them with the hashtag AskPerFinEx in the comments. See you in the next video.